Hey, folks. Reet Rob, Leslie, and Mitchell, I requested you guys be co-hosts. That way we can have like 12 people speaking. I dug into some of the details. So if you accept as a co-host, you can just be a speaker. There you go.
I'll be on in a sec.
Yeah, no worries, no worries.
Okay, cool.
Rob. All right, perfect. There you go. Request. There you go. Reet Rob, you're making this a regular appearance, my man.
Hey, thanks, Rob. How's it going, guys?
As I'm doing well. How are you?
Good, good.
Good. XLRE added to that risk range today. You know, you're back in the you got you're two out of four ITV and XLRE.
I
You
know
know,
I got dog in the fight.
you're in the you're in the hot seat. You're in the hot seat.
I know, man. I know. It's
uh,
fascinating. It's been really interesting because, like, obviously for a variety of reasons, my sector broadly, it's kind of moved into the spotlight amongst the two other kind of key ones. So it's always interesting.
totally. And it yeah, I mean, it's definitely one of those ones where it makes perfectly sense. It's back in there. I was actually pretty happy because it works in both quads, right? So it's like
Yeah.
it's kind of brilliant.
It's funny. I have to at some point I have to pick Keith's brain a little bit because I'm in this, at least in my sector, I'm in this weird place where it's getting harder to find like stock by stock kind of like very obvious home runs, if that makes sense.
Mm-hmm. Mm-hmm.
Because so many of the things that were those obvious home runs have worked out so well. So I'm like back at the drawing board trying to find the next idea. It's an interesting time.
Yeah, and I think one of the biggest things from in your world, Rob, is I'm sure as we transition or think about kind of you wrote this in the early look this morning about kind of that the quad four, deeper quad four and Q2 environment, and so then what does that look like, right? And on the grid, deep quad four are pretty shitty for REITs, like in
Yeah.
general, kind of down 6%. So you may I know you got cold, and again, I don't think I believe most folks know this, right? I mean, cold's still on the
It is.
still on the investing ideas, right, on the short side. So
It is.
we got that bad boy that we can keep hunting and kind of trading in and out of, but there's bound to be, I'm sure, some others maybe,
Yeah.
but
Well,
that
store. It's funny. Like, no, sorry, not to cut you off, but
no,
like
you're perfect.
dovetailing with what you said. At some point, storage is going to be a really interesting short.
Yeah.
I'm one. I think how this plays out. What they're gonna do when they put out their full year outlooks in February.
Mm-hmm.
They're gonna guide conservatively, and then like the first quarter is gonna blow it out, and everybody is going to take up their numbers, and stocks are like there's going to be a dip in February, and then the
Yeah.
stocks are going to rip higher through like May or whatever. And then like I'm thinking that's the time to turn around and short them because the back half is when things like really decelerate. You know what I mean?
Yeah.
And flip.
Yeah. Nothing's more fun to put a short on a long that you've ridden, like again, I'm not saying you're going to short PSA, but like something like a PSA or something, right? Like
Yeah.
again,
Well, there's one NSA National Storage Affiliates that I
okay.
haven't spent a lot of time on.
Okay.
The space is so highly correlated, but that
Right.
one has like 9 times leverage, where the rest of the space is like between
Wow.
4 and 6.
Yeah.
So like I'm eyeballing something like that for an outlier on the style factor front. You know what I mean?
Yeah, and that goes back to like your conversation last Wednesday when again, thank you. You're too kind to join on a regular
Oh
basis,
no, of course.
but yeah, that goes back to kind of like that conversation we had about leverage, right? And like kind of in a quad in a shallow quad one environment or a quad one environment in general, those type of leverage plays rip to the upside or certainly get bid up more quickly and more aggressively because they're not they obviously have more torque, right? But then on the flip side, in a quad four environment, they also go down a lot faster. So it's like
Yeah, yeah.
timing it appropriately or picking out the right one. So for those that are new, that was NSA, a little sneak peek into something that might be coming in the future. I'm certainly
Yeah.
writing that down in the notebook on a notebook
Yeah,
review on a Wednesday here. So we
definitely.
got um, a lot of thanks for joining. I see 1000 there, X2 Turtle, Fracted Cat. Got a lot of friendly faces on here, so thank you again for joining. This
Yeah,
is
hey
sort
Rob,
of yeah.
I'll go on mute and just take a back seat so
Oh,
you guys can
super.
do your thing. Yeah.
Yeah. So we're going to do 2 sessions today. So this one's going to be a little tight because the wifey's got a yoga class at 6, and I need to take care of the wee ones. But then we'll pop back on tonight around 8:30 and kind of finish up, whatever we didn't discuss or didn't get a chance to review this afternoon. So yeah, we can kind of dive in. We can either open up to questions. Jimmy unfortunately had us a little bit of bad news. So his dog's at the vet right now. So everybody please send some prayers and love for Jimmy and his really cute bulldog. He shared a picture with me or with a kind of a group, and so that's unfortunately some bad news. But
Hey, I really
yeah,
appreciate that.
yeah, man, I'll sending all the love your way, my man. But yeah, I mean, I think hopefully if you're executing today, you were selling a lot. That's certainly my biggest takeaway. I had a ton of sales again, 2 days in a row. Basically shoring up cash, and X2, made a comment about he was pretty certain that coach is going to be sending a signal on US dollar at some point, and he did, which is awesome. So I think that was a great. I was in a couple conference calls here at the close, so I missed those last couple RTAs. So the short Norway, and then he covered EXAS. Got it. So Norway is obviously pretty standard if you're paying attention. I'm already short Russia, so pretty much oil in general sucks, and I think that's the general. Rather than hitting the button again on USO, he went to Norway.
Yeah,
Which
were you able to short Norway at all? Because
no,
I have TD, but I couldn't borrow it.
I did not try, honestly. I basically had calls from like
Yeah.
you might not have noticed it on Twitter because I was only half paying attention to my conference calls, but but I didn't really execute. And
But
yeah.
you're spot on about USO though, right? He didn't want to hit the button twice. I layered into that, so I shorted a little bit more at the end of the day.
Yeah, that's that. I mean, I kind of got in, oil a little bit yesterday. I mean, again, like small, like 25 bips, and then added about, another 75. So I got about 100 bips short on oil today, after he kind of hit that button, and then obviously incrementally kind of added more as it sort of not going away from us, but just sort of after he tagged that button, it obviously moved higher. But that's definitely a big one. I think we're shaping up. I mean, the market's certainly dictating or sort of conveying a bit of a hybrid quad one, quad four, right? I mean, quad one was kind of today in general, right? What was leading? Sorry, guys. U.S. sector. Yeah, I mean, you had consumer, tech, healthcare, real estate with your top four, and then materials in terms of day performance. And in terms of 1 month price momentum, I doubt things have shifted much. Yeah, you got REITs, healthcare, staples, Utes, and then tech is, basically with the momentum the last few days has kind of regained 1 month single strength. The interesting thing that I'm just noticing right here, and you guys are getting this real time, so bear with me. Energy is only about 11 basis points away from regaining 1 month momentum. So that's XLE. So that's definitely something to pay attention to. I think Fracticat, Joe, you sent a tweet around, I believe yesterday, saying there's a potential for a squeeze here, or certainly kind of a gap higher that people are going to chase. They're going to, say reflation or what have you. Deflation certainly isn't in play anymore. They're going to kind of get basically churned up and spat out when when things really kind of hit the fan, or sort of get more settled down in Q1. And I think that's exactly what's happening, right? Commodities, oil in particular, energy, sort of trying to make a bid here to kind of regain 1 month momentum. You've got a lot of different components here. But Joe Cat, do you want to say something along those lines? REITs are still, Rob, REITs are still, strong. XLRE, NVNQ. I know they're kind of different, basically underlying components in there, but they're the top dog on a 1 month momentum. Yeah. What's I don't know the under subsectors there, but is there? And then home builders are right behind them in terms of like U.S. industries. Do you have? Do you have favorites? Just while we're since they are so strong right now, do you have any favorite like subsectors at the moment inside that REIT world?
Yeah, I've been very bullish on the coastal gateway apartment names, which which conveniently actually make up a pretty big portion of the index. So AVB is up there, EQR is up there, Essex. What's going to happen too is
are those both in XLRE and VNQ? Or are they bigger in one of the? Again, I can do this research myself, but I don't know if you know that off the top of your head.
I'm pretty sure that AVB is a top 10 or 12 for both, and maybe EQR and ESS move around a little bit more.
Okay, no problem. Yeah,
but they're larger cap names. So like you're seeing like PSA has been catching a big relative because it's a huge part of the index, and then the other stuff that's top of the list are the data centers and the towers. So AMT. Equinix, EQIX, DLR. Those are kind of. There's another office company called Alexandria Realty, ARE. They do life sciences. Basically, all the large cap stuff's been outperforming.
Got it. That makes sense.
Oh, and then on the towers, also Crown Castle. I think that's CCI, I believe, and SBA Communications. They're all big components.
Okay.
And one thing that's interesting, really quick, the towers and the data centers love Quad 4. Love it, love it, love it, love it. Which is interesting.
Yeah, what's the back test like that? I know, obviously, they've got that larger cap. Somewhat more S&P-like exposure. For a while, I think over the last few years, there have been a couple of periods where they've been really correlated with the tech names.
Yes.
So like when the data centers were signing those mega deals, they were tracking the FANG stocks pretty tightly for a few quarters, I'd say.
Yeah.
I'm kind of curious to,
I wish I could.
The dynamics are different.
I wish I could share my screen right now. I'm actually pulling up our backtest model, and I want to pull. Bear with me for a second. I'm going to pull up.
Don't want to put you on the spot, but that was
no.
Came through my head.
No. It's a good question. So like Equinix, let me pull up Equinix really quick because they're the big dog. They've been around for a while. EQIX.
I was going to say that's EQIX, right? Yeah.
Yeah, it's EQIX. Okay,
that is a strong signal.
So looking at Love's Quad 1, the batting average is like 75%, and the average or like expected value is something like a high 20%, mid 20%, so call it like 23. And the one thing that I've learned to pay more attention to is kind of like how they handle the quad pivots. So like if and when we go from 1 to 4. The average return is like 6% in a quad 4, and it only has one quad 4 state or one quad 4 degree or kind of transition where there's a negative return, and that's a deep quad 4, which could matter, but pretty much every other like state in quad 4 is a huge positive return relative. I wish I could share this like somehow share my screen, but unfortunately I can't. Yeah, that's how I'd characterize it. But again, just a back test. But yeah, but if it's got a strong signal, it makes sense dovetailing with that.
Definitely.
Cool.
You got it.
My last question on the REITs was just like, I know every year, after a strong year like this year, there's maybe a bit of a January effect. Typically, managers will look at names that have just really underperformed for a quick rebound or something like that. But I wonder if we're going into a quad four and if a lot of those names have underperformed for some time on style exposures. Have you spoken to any of the buy-siders to get a sense of where they see value today? There's such a big dichotomy between like how the generalists look at REITs from a style factor and then me looking at the implied cap rates with like massive premiums everywhere. And like, it's like being in PLD for the 7th year in a row, right? Like, what do you do when it's trading at, what do you do as an active manager? I do wonder if there's any incremental inclination, let's say, to dip into the risk curve, but that hasn't really worked.
Yeah, well, a couple of things that I'm hearing. So, believe it or not, people still like the buy side, both like long only and long short, like the SFRs here, especially as they kind of lagged in the second half of this year. People are still pretty bulled up on them. The apartments are rolling over a little bit in terms of sentiment. I personally think that like the Coastal Gateway, there's going to be this interesting divergence between like the MAAs of the world and like the EQRs or AVBs, at least on a relative basis, with like MAA underperforming. But in terms of like sector laggards, a lot of people are taking a look at the strips. So like your Brixmors, your FRTs of the world, which do work well in a quad four. And I think like have obviously lagged for a variety of reasons. Maybe not in the in like the third quarter, but I am hearing a lot of people talk about the strips and then finally healthcare, which candidly like I know the least. I mean, Jimmy, like covering healthcare it's a full-time job, and
the more I cover those companies, the more like I totally get why there's like a complexity discount. There's still a lot of reimbursement risk. There's changing business models, right? Changing asset classes. Not super clean.
Yes. Yeah. And then so like just acknowledging my own weakness, and like Keith always says, like saying what you don't know, it matters. Like I personally don't know the healthcare names well. One thing that's going to be that I think is also going to be really interesting, the timber REITs as a short. I'm thinking about that a little bit, especially as like we've seen commodity prices roll over. Lumber hasn't followed, and like obviously the timber REITs are very like highly correlated with lumber prices. It could be interesting, but I'm thinking about how to tackle it. But you hear that a little bit as well as like a potential short name. So that would be like, Weyerhaeuser, Rainier.
Cool, man. Thanks for the.
Yeah.
And for those that are wondering, and if you bought wood as a commodity play, that ETF is not an exposure to timber. Just to give you a heads up, that's actually an exposure to the underlying equities for the most part that that invest and produce timber. So Weyerhaeuser, who WY is the ticker, that's about a 8 3/4 weight inside of wood, WOOD. So when that time comes, or if you listen to the call and REIT Rob says that he is going bearish on them, and you don't necessarily want to pick one particular one, you could always go to wood. But it is typically on the short side, better to say short the underlying and maybe go long the ETF. So, go short WY, long wood, in proportion. And it's a great way to kind of be a little bit neutral. But most of you are pretty savvy investors and probably already knew that. So getting back to the notebook, anything standing out to anybody? You got a lot of speakers here. So Joe Cat, Chris,
Can
Mike.
I just ask Rob just one more question?
100%.
Question.
Mike,
U-Haul on the in a quad 4. Does that play out?
Yeah. You know, it. Well, I wanna. It's funny. I want to obviously like I know the fundamental thesis there, right? And to me, it's a long, but the signal is going to matter a lot more when the time comes. But just in terms of like the quads, so U-Haul loves Quad One. It's kind of got like at least historically, and it has a pretty like long historical back test. It works best in Quad One at like maybe a 13% or so expected value and a 75-ish% batting average. So pretty good. Quad Four actually likes it as well. It doesn't do well in Quad Three. So it hates Quad Three. Quad Four is like not quite as bullish as a Quad One, but it's still like has a positive, expected value. Like anything else, though, deep Quad Four, it's a kind of a shit show. But for what everything's a shit show, right? But there's no reason not to like it, based solely on like a normal or quote unquote average Quad Four.
Got it. Okay, thanks. I appreciate it.
And while we still have Rob, I was wondering, you had said Blackstone was making a purchase the other day.
Yeah. So a couple things.
And I was just wondering what you think of Blackstone itself, because I like that company.
Hey, Leslie, how's it going?
Hey, how's it going?
Nice. I don't think we've talked before. Nice to talk to you, finally.
Nice to talk to you. We've
yeah.
chatted forever.
I don't mean to like punt, but I have to defer to Josh Steiner on that one simply because
I was wondering if it was more of a financials.
Well, here's what I would say. So it's interesting. Like it behaves like a financial, but it's a massive real estate company,
Right.
where it has massive real estate exposure. So what it's been doing, it has this really interesting structure in addition to its like legacy real estate funds called the BREIT or the Blackstone REIT. It's actually like a private REIT, non-traded, that functions as like a fund entity and pays fees up to Blackstone. And it's such a massive pool of capital at this point with so many assets jammed into it that the only way to really like move the needle on their fees and on returns is to like do big chunky deals. So Blackstone just bought a chunk of One Manhattan West on the west side for, I think, like it was a multi-billion-dollar purchase. They just bought the apartment assets out of BRG for over $3 billion. So what they're doing is they're putting big chunks of capital to work rather than like onesie or twosie little deals that aren't going to move the needle for them, if that makes sense.
Yeah, for sure.
So that's what's going on there.
Okay.
They always used to say that when Blackstone sells, it's time to get out, right?
Yeah. Well, it's funny. Like, so they spit the bid a little bit on Invitation, right? Invitation was a Blackstone. Invitation Homes, INVH, was a Blackstone portfolio company. They kind of like incubated it and then took it public and gradually sold down their exposure because they thought that like the trade was done in single family homes. And now just this past year, or last 18 months, they've gotten back into the space in a big way. So generally, yes, but not always. It's actually, I find it more interesting like that they're getting back into single family rentals even after the run it's had, to be honest.
I just remember in I think it was it 07 or 08? I think it was 08, the last single name deal with extended stay.
Well, EOP, they took Equity Office Properties and Hilton private too. EOP and Hilton were kind of like the last gasp of the real estate take private. And yeah, they did have extended stay, and it kind of turned into a little bit of a shit show, and they had to clean it up and stuff. But EOP and Hilton, I think, were the very last big deals they did in real estate, at least.
Right before the crash.
Yeah, Jimmy, hand up.
Yeah, I wanted to continue on the notebook review. I know we were touching on a few things earlier about energy and XLY, a couple of things that don't look quite as good, making a run maybe on lower volume, right? I thought it was interesting how, going back to the notebook, XLY had a 3-week stint on the risk ranges, December 1st and here we are. I got booted for XLRE, but he's benching that name. But today it hit 200. So I'm not sure what trend is, but maybe it just got back to bullish trend. It was teetering there. It made a series of much lower lows, right? For a while, the low was like 199, around 200, but then it went down to 190. So curious to hear what you guys think. Again, Amazon, Tesla, just the fact that it's been choppy, the signal strength doesn't look great. But maybe it was just like a near-term thing for XLY.
Sorry, I think you said XLY, but you meant XLI, right? Industrials.
Oh, yeah. You know what? I was referring to both. You're right. XLI got booted.
XLI got booted.
Keith mentioned on the morning show how he's been punting XLY, right? He benched it.
Correct.
In his PA, but since his benching, right, it went from 190 to 200. So it kind of recaptured some key levels, but I don't know how sustainable that is.
Correct. And I think, obviously XLY, some of the bigger underlyings is going to be Tesla, Amazon, that kind of thing, right? So both of those were negative this morning, right? Tesla, I suspect, regained positive risk, like positive trend, or positive trend, whereas Amazon still kind of again, it was up today, but it's kind of flailing on. It was up on pretty low volume given its average 1 month volume. So I suspect that the Amazon's probably the biggest there, Jimmy, would be my humble opinion, in terms of what's driving that XLY. And again, XLY is neutral, so why own it when you can be along something like an ITB or XLK, or even XLRE, right? Where he added that this morning. So I think it's probably more just like signal strength versus he doesn't necessarily like it. But yes, I think it was the 20th, so that was what, Monday. He mentioned that he was all out of XLY in his top 10 macro positions. So yeah, definitely something that I've been trimming into this strength the last 2 days is XLY first, ITB as well. Obviously, we got that RTA earlier today, and kind of just, again, I mean, like with VIX and Vixen, where they are at like basically 1 month lows for the most part on both of them.
Very deceptive, right? Both at the low end of the range.
Correct, right? And like if you weren't selling today, you definitely weren't executing on the process. If you weren't trimming across the board, again, maybe yesterday, I certainly trimmed some, because again, it was trending lower, but who knew what it was going to do today? Well, today it got truly to like almost the bottom of the range. What I think VIX closed at like 1863, and low end of the range today was 1804 on the sheet. So
let's get one more day of rally. How about that?
Right,
why not?
That'd be fine. That'd be fine with me. But again, just from a process-oriented standpoint, I think you really got to stick with it, and it's something that I really have worked on really hard and executed well in the last kind of like 2 weeks, is patience in terms of when to kind of deploy the capital, and not worrying about kind of missing something, but then being ready when you did get some, the volatility spikes or stuff was at the lower end of the range, like Tesla, right? The other day was a great example. I actually, even though it was kind of negative on the pin sheet, it was just the price action just basically, it was at the low end of the range. Vixen looked like it was rolling over, and now 2 days later, again, I sold it well below 1,012 because I wasn't going to fucking run with a negative, something that was negative on the pin sheet, but is now at 1,012, just above the the risk range. So again, these things, I think it's just really important to kind of just have your eyes and kind of understand where do you want to kind of deploy that capital when. And that kind of thing, right? And now you've earned the reward, which is something that I in the past have not done in terms of, take money off the table when I'm right? I mean, there's like, some of these names have run 4, 5, 10, 12% in the last like literally 2 to 3 days since the lows on Monday. So, depending on where you bought in, even if it was on the 17th when, Coach was a bit more, quote unquote bullish, I would say on the 17th when he was setting out some RTAs. even if you got prime opportunities to trim some of that today, in the green, and now you can just sit and kind of wait for an opportunity to deploy that. Whether it comes tomorrow or next week or in early Q1, there's always something to be buying at the low end of the range. So that'd be my 2 cents. But great call out though, Jimmy, in terms of like the XLI getting booted. And he also sent that rock like RTA, right, saying that industrials just don't perform as well in a quad one, narrow quad one, shallow quad four, and certainly not into a deep quad four. Joe, yeah, by all means.
Yeah, just wanted to follow up. I know you referenced my tweet from earlier. I think, and we were kind of touching on this in our chat. I kind of, we're, whether we're still officially in the chop, we're right around the chop bucket of volatility, right? I kind of look at it as in the land of the chop, mean reversion is king, right? So that, and I was kind of touching on that to you, is there are points I think where the risk ranges have maybe less value than other times, and it feels like we're at a point now where they have a lot of value, maybe more than ever before. And I know in the Facebook group, the Learning the Process group, like almost a year ago, like the beginning of this year, we were all kind of having the opposite problem, where like we were taking profits at the top ends of ranges and the things we liked, and they would keep running. And it was like, oh, how do I stay with something? How do I stay size with something to make sure I'm capturing as much as I can? This feels like the opposite. And not only that, it feels like these OODA loops, if you will, are getting tighter and tighter and tighter. Like just even like you kind of separate the math from the feelings. I mean, just over the last, maybe even the last 3 months, the whole quarter, but even over the last, especially the last couple of weeks, these elation feelings at the high, and you sense it on Twitter, you sense it with the market, you sense it if you're watching, CNBC, that it's like we're right there, we're right at all-time highs, everything's bullish, there's not a cloud in the sky, and then a few days later the world's ending. And like that, we went through that last week into Monday morning, the world was ending, and then yesterday and today, now it's sunshine and puppy dogs. And that's kind of why I'm looking very closely now at the VIX risk range and where we are within the range of the VIX. And even now, like you just said, if you're not selling today, you're not executing on the process, because the world could be ending tomorrow, Friday, or market's closed Friday, but next week, we could very easily go right back into that sort of world ending feeling. And then eventually that's going to change. There's going to be a point where there's persistence, and the persistence could be to the downside. And so just to take it back to the tweet that you referenced, that's, I'm trying to stay focused on what is and not, predict the future and make a call, but it feels like that's lining up the way I'm kind of thinking about it with what Keith is saying. Is there's really two scenarios, at least on the table right now. We're in quad one and we're going to get a little bit of quad one, or we're already in quad four and it's just going to take some time for the data to reflect that. And either way, it's either there's going to be this head fake into January, that beginning of the year, suck everybody back into whether it's inflation trade, inflation names, and then dip over, or that persistence starts now. So that's kind of where my focus is on the volatility, see if that, if that trend were to change, or if, where we are in the chop changes and there's a little bit of persistence there. That's kind of at the top of my list for which of those scenarios are we in? Are we going to get quad one? And if we do, it may not be for that long.
Hey Joe, really quick, that line in the land of the chop, the risk range is king. I freaking love that, man. That was awesome.
Thank you. Yeah. I think it could be, there are points where it's persistent. You want to kind of run with it and let your stay with size, capture that trend. And then there's points where you got to play the mean reversion. I feel like it's been mean reversion for a while. I don't want to say I feel. The math is indicating that it's been mean reversion for a while, and that's going to change. It just doesn't seem to be there yet. And I think that's kind of how Keith is playing it. And he's there's points where he's like riding it, and then there's points where he's in and out and he's bouncing at both ends of the ranges. And it's felt very much the past couple of weeks like he's bouncing. He's bullish, he's bearish, he's bullish, he's bearish, because the math is telling him to do that.
He's in full on trading mode right now, like full on power trading mode.
And I could see that frustrating some people, especially it was tough. It was a tough learning curve for me, but there's different kinds of Keith, and there's a very particular kind of Keith that's trading right now, and it pays to trade the way that he's trading, or not at all.
Really quick, I don't mean to butt in, but this actually may be useful to you guys. You know how like he says sometimes on the call or on the macro show, he'll be like, when I get off the macro show, I go and stand and like run my process and like don't talk to anybody for a couple of hours. That is like absolutely true. I made the mistake when I first started. Not really a mistake because Keith's like a really nice guy. I went over to him and I was like, just said good morning, and like he was not interested in it at all in like engaging with me because he was like running his process. I learned really early on, like let him do his thing and then get back like around noon. So anyway, quick interjection.
Bring him a salad and maybe a coffee or Diet Coke.
Yeah, exactly.
Do you know what?
That's too funny. Yeah, go ahead, Chris. Sorry, buddy. Yeah.
No, it's something that I was thinking about. Just talking about. It's something that whether we're there or whether we're not, it's where we're kind of going to. But in Quad 4, there's not that much to buy. So if people have been struggling in Quad 2 with getting into names and riding them when there's like 1,000 names that you can pick from because, the tide lifts all boats, then people are going to really struggle with Quad 4 when there's only like 30 things that you can buy.
Yeah, and most of them are fixed income and gold.
Exactly. Like, there's only
or UUP, which is like the most boring thing ever.
Exactly. So if you don't nail your core positions at the right time, then you can really screw up because everyone gets trapped in that. Oh, I make a 1% starter position or whatever, and then I'll add to it, and then you never get a chance to add to it. So if you've been struggling to get into something, like an equity ETF that a core position is 3 and a max position is 6, whatever, then how are you ever going to get to like 12% in UUP?
Yeah. And like REITs is a great example, right? XLRE on Friday, it barely, rolled over. It basically closed relatively flat. And then on Monday, we had the big sell off, but it got to like the quote unquote middle of its range. It got only down to like just sub 49. So yeah, if you didn't buy then, you're now, it's back up, it's basically a buck higher, and it's a tough thing to do, but it's really important to like understand, okay, what are my kind of core asset allocations that I want to get exposure to and to add incrementally to them. Gavin, you're raising your hand, or Mitchell, or either one.
What's up, guys?
Oh, hey guys, I got to run really quick. I got to get dinner for the kids. Have a nice night. Thanks for including.
Thanks, Rob.
Thanks, Rob.
Thanks, Rob.
Later, guys.
Thanks, Rob. Appreciate it. Gavin, what's yours?
What's up? What's going on?
Good.
I was just going to add on to the XLRE. I thought it would be interesting just to compare and contrast it to XLY. Just looking back at my notebook, for me, XLY, actually, I never bought it, I never bought it. And I guess, some might question that. But for me, the signal, ever since it, entered my notebook, it was never really strong enough for me to really want to get in there on days. So XLK and then ITB came in, I guess it was like a few days after XLY. And so those were the two horses. And then, I just wanted to say, like, for me, just so you guys know, like XLRE today, first day it's in, I get to gauge the signal strength, and, I put a half size position on immediately, so to what Chris was saying, like sometimes you like, for me, I just need to put money where it needs to be. And XLRE comes in today, and it's just strong enough for my own process to know, okay, well, I need to put some money there immediately. Whereas XLY came in and I didn't see the same strength, so I guess it's like, to each his own. Like you guys may see that or may not, but for how I track things in my notebook, that's how it went down for me, and we'll see how REITs do. But given what we're seeing, and how Keith is starting to signal, I'm happy with just getting some money in play there,
So, you guys mind if I say something?
No, please go right ahead.
I didn't know who was next. I apologize. It's kind of funny. I've been writing my monthly, and I go back and forth with my editor, who's in Vancouver, and we both chuckled a couple days ago as we're going back and forth these edits, and we're talking about positioning. And he made an analogy which was hysterical. He said, "You remember when you were, a teenager, you never really got in trouble when you didn't get fucked up and you left the party early. It was usually the guys who stayed at the party a little later that either got arrested or did something stupid or whatever." It just made me laugh, because then Keith wrote this morning in the early look, I can't even remember what he did, but his last sentence was basically along those lines. If I'm early, I'm early, but it's going to happen soon, basically. So I can't help but to think, even if we do go to when we do go to a quad four, because we're going to get there, it's quad fours, even in the things that do well, are still going to have shitty days. Like, quad fours are pretty ugly. You get more of the negatives than you do the positives. So there are going to be a lot more times in those quad fours where you can get the low end of the range. So, buying dollars is with Keith's last couple of RTAs. I'm buying dollars, right? I'm putting some of that green money to work in dollars and just basically sitting there, parking it there. I'm okay buying green. The patience, I think, becomes much more the key in a quad four, and not being afraid to hold the money on the side, pick your spots on your stronger names, but be greedy to the downside. Wait for it to get to the downside, because I can't remember, even in a handful of the quad fours, Q4 2018, I wasn't following Hedgeye, but I didn't know it was a quad four at the time, but there wasn't much going up, regardless of notebooks or no notebooks. Most things still got hammered during that 4-week time period. And obviously we know in the first quarter of last year, everything got smoked. Even bonds got smoked right off the bat, right?
Yep.
So, everything got smoked. So it's quad four, while I know cash isn't something that he likes to go to, or it's not professional or whatever, if it's UUP is your cash or whatever your cash is at the time, don't be afraid to navigate that quad four deliberately, like Gavin. He's waiting. He waited on that XLRE. The signal strength wasn't strong enough. Don't be afraid to be selective in a quad four. Not losing money is much more important than making money in a quad four, because then you have the ability to just push to whatever you want as the Fed comes out with their next innovation or whatever it's going to be. Who knows what they're going to come out with? Who knows? But they're going to be cutting rates at some point in time. They're going to start buying back in a deflationary time frame, and that quad four could last 2 quarters. We just don't know. So that's my only thought.
Yeah,
Gavin?
actually, Mitchell, I was going to just add in there that, Keith switching to more fixed income longs is kind of his way of saying it's better to just be safe and earn less, heading into a quad
100%. I'd agree with you. I would. You put it more succinctly than I did. So thank you.
I think
Not
that's
hard
a
to-
good point. I mean,
Not hard to
because
do, Mitchell. No, I'm just teasing. Sorry, go ahead. Go ahead, Gavin.
I think that's a good point, because, it's actually, I find it much easier to be, to have a portfolio on where I can be long equities and fixed income. I mean, just something really simple. Like if you look at, SPY and TLT, over 2021, there were only 6 weeks where both of those markets in the same week were red. So if you just think about that, like you have more, it's easier. It's not old wall. It's just like when you have fixed income longs and equity longs on, it's easier to just have more balance in the portfolio, and I think what Mitchell's talking about, it is important to remember how quad fours kind of play out. It's like they don't get priced in right away. Like you have to get ahead of it, but the equity component, like you can see things shifting, in rates and different things pointing towards the quad four, but the equities are going to come out of nowhere. And it's just going to be that liquidity event where if it really does happen that way, where just everything goes down, everything is getting sold, like to Mitchell's point. But it happened, like that's not like a whole month of that. That's like that 1 week, you know, where it's like equities, bonds, gold, everything is getting liquidated. You know, like that's a quad 4 if we actually get that kind of event. But it's not like you have a whole month or two of that, you know. So I think it's important to remember. But so you start building out, I think like what Keith is doing is you're starting to build out that fixed income side. And to the point I made before, then you start to have more balance in the portfolio. So maybe it's easier to stay, because look, S&P is still bullish trend. And I think it was Monday, Keith called out the trend level for the S&P 500. I don't know if anyone noticed that. It was
45.19. Yeah, 45.19.
When's the last time you heard Keith call out the trend line for the S&P 500? He hasn't done it once in 2021, probably.
And also, when was the
Right?
last time you heard him refer or suggest that the NASDAQ or Qs are making a lower high?
Lower high. At the same time, you know, Russell goes bearish trend. So there's
Right.
definitely some things happening. It's not time to get freaked out. It's still like, hey, I'm long S&P. I think we're going to make all-time highs.
Right.
VIX is still bearish trend, you know?
Yep.
It's tightened back up quite nicely, actually, where I think it could tighten up. We might get one more head fake, you know, higher. And then, you know, what's your portfolio going to look like in 3 weeks if the VIX is at 16? What's it going to look like? You know, because I could definitely see equities running in Q1 before, you know, we have kind of like another volatility spike. And then maybe that one develops into something else and VIX goes bullish, you know, who knows? But
Well, that's kind of what happened in February 2020, right?
Last year. That's exactly right.
Everyone I noticed because at the time I took a job helping a friend out and I was driving, so I had my podcasts and stuff running pretty much all day. Well, yeah, until about 2:00. I'd normally finish about 2. So I had a lot of stuff playing in the background, and there was no end of people sort of commenting at that time. They were like, "What the fuck is going on? There's people like dropping dead in China, and Apple is making an all-time high." Like, and I know I'm following a lot of Mike Green stuff because I'm making a couple of videos kind of linking his passive thing with
passive thought. Yeah, it's crazy.
And the way he kind of explains it is, it was just enough of the active managers sold because they were listening to these things and reading these things, whereas the likes of all the big aggregators, they don't care. They just buy. If you pay into it, they buy stuff. So it was just enough of the active managers
on those passive.
Yeah. So there was just enough active managers just tipped it over the edge, which sent everything crashing. And I just wonder at what point, because you can still hear, like whoever mentioned it earlier on, you can still kind of hear it. People are still talking about new highs and all this sort of stuff. Like at what point does the realization come, right?
I think it's important to note also, though, you're looking at shallow quad 4, quad 1, possibly for Q1, and then you're looking at back-to-back quad 4s, which is not what we had, or which was not what was on the pin sheet, I don't believe, back last year, right? So you put 2 quarters of back-to-back quad 4, it might be more than we anticipate, Gavin, on that, you know, more than just a down week or so. You know, it could be a prolonged scenario. And then the questions come in, when does the Fed try to create a new innovation? And some of you guys on that loop that we have know my thoughts on that. You know, I find it difficult to believe that you have Republicans, Democrats agreeing on anything, and they're going to be needed to create that new innovation based upon the CARES Act getting rid of those innovations, right? So there's more to think about, and obviously we just try to plan for most scenarios as we can think of, but those are definitely thoughts to keep in mind.
Yeah, Mitchell, I think that, no, you're right. And I didn't mean to say that. I think we were talking off just, back-to-back quad fours, 2 quarters. That would be something, well, that we haven't had that in a while. But I guess I was just kind of referring to, when it does happen, if and when, just kind of a reminder, like, yeah, all asset classes will go down, like in a liquidity event. And that doesn't mean, you shouldn't have your bonds on. You know what I mean? But just to remember, like, that's how it usually plays out in a series, like, I don't know, just look back at all those kind of liquidity events. Everything gets sold.
And that's the acute event as opposed to the chronic kind of drawing out of quad 4. And I think you often see both at different points within a quad 4. So like in March 2020, there was that acute event. Like I distinctly remember that day we were long gold. Keith was bullish gold, and there was a day that he sold all his gold on red, and it saved everyone who listened to it a 10% haircut. And it was the beginning of that super acute event into the beginning of March of 2020. I think even bonds ripped to the upside, then they sold off, everything sold off. So it's like, how do you prepare for that? You either, you've got things you can put on that are going to work for that sort of chronic stress of quad 4. So bonds, gold, REITs, utilities. But then those acute events, there's really nothing you could do. You're either short or you're carrying a larger cash position than you otherwise would, or you're going to take it on the chin. And I think that acute kind of event that happens is certainly what hurts me the most, because I think I don't have within my process in the way that I'm structuring my portfolio and making those decisions week to week. They tend to catch me by surprise, the acute events. And I think it's the opposite of those sort of acute events in a quad 1 or 2 environment where it's by the damn dip. And that's what caught me off guard this year. So the worst period for me, which I'm sure was the case for a lot of people in 21, was I think it was October, like through October, where you had these acute dip events leading up to that. So there were 4 or 5. It was like every OPEX every month, right? For the whole of 21, where it was like big, quick drop down, couple of days, buy the damn dip, and you're good 3-4 days later. And then you had that slow grind materialize in October that I certainly wasn't prepared for. And I was way too long, and it kept going down day after day. So now you zoom out and see that sort of fractally over what we're talking about 2 quarters of quad 4. People are going to get killed. Nobody's positioned for that, especially if they're macro unaware.
Yep.
Sorry, go ahead, Joe. Yep.
Yeah, Jimmy, I apologize. Go ahead.
Is there a way?
Yeah,
is there a way to short? Sorry, Jimmy. Is there a way to short Substack? Because obviously, all these letter writers that have come out over the last 18 months are obviously going to get on the back of all these quad 2s.
Hey, Chris, I don't know if
guys,
I don't.
This is exactly why I'm doing 2 sessions today, because Thousand Era FX right there, Chris. We love that British humor, my man.
Well, Robert, Chris, I don't know if you've noticed. But we've been blessed with greatness because I think Professor Plum, Mike Green, is listening.
I didn't want to call it out, but I saw.
So I don't know. I don't know if he wants to say something, or Chris and you and he want to have a conversation. But I would be all ears for the next 4 hours.
Well, that is interesting. Like, it would be. I don't know if he can even comment on it right now, but like, what happens to all the passive money that's coming in? Like if S&P was bearish trend for a prolonged period, like what does that even look like? How does that work?
Well, the point is, it'll always come in, won't it?
Yeah.
Isn't that why it bounced on the 24th of December in 2018? Isn't that why it was like the bounce was so acute in March, whatever it was, the 23rd? Because the money comes back.
I think the passive money never leaves.
Yeah, exactly.
The passive money is constant. It's the active sellers that are the ones that are selling more than what the passive buyers are buying, in theory. But also, you can say, well, maybe it was the active buyers also adding to the passive buyers. And I don't know this. Mike's work is so granular. But it might have been the active buyers coming back and joining the passive buyers when the Fed basically backstopped every junk bond that was trading. So I don't know. I wouldn't claim to, but I'd love to hear it.
Because the other part of what I've been looking, because I don't know if you've seen, I posted a little while ago what the quad returns would have looked like at different parts of the year. So I've done like 2021, 2020, going all the way back to 2008.
Yeah.
And because the quad is a quarter, and it's still listed, so whichever quarter it is, so let's say it was Q2 of 2020 was listed as a quad 4, but obviously the S&P bounced on the 23rd of March. So what happened in Q2 has had a big effect, especially on something like GDX. Like GDX's expected return in quad 4 has jumped from like 3% to 7%, because in quad 4 in March, GDX went up like 57%.
I think that's part of one. That's one of two reasons, at least for me, why the back tests, at least for the performance, need to be taken with a grain of salt. There's the low end, like what you're talking about. It's a relatively small sample size for each one.
Yeah.
But then more particularly for me, at least, it's that they're not distinct events that begin on like the first day of the quarter. They're sort of amorphous transition. Whereas something like active versus passive and the dates with which passive funds are allocated, like those things are, I would think, a little more distinct. I mean, Mike Green knows that stuff, way better than I do. But yeah, what you and Mitchell were talking about, that was you're talking about the sort of drastic bottom or pivot within March of 2020, right?
Yeah.
Yeah, and so the question I have about is, there's the active and passive component, but then there was the change in the Fed's policy position, right? And everything that they did into March 2020 and the sort of U-turn that they did, you could call it dovishly. And that's kind of where my head is at for the next 2 quarters. Is they're doing what they always do, but in an even more obvious way than I've ever seen, specifically in terms of tightening into a slowdown. And if
I don't know, but Keith mentioned it the other day. He said, Jay Powell's learned from 2018, right?
I don't know.
That's what he said.
Saying,
sure.
I don't know. Like, he hasn't tightened. He hasn't hiked. I think he learned from 2018.
Well, I think it gets so nebulous, right? There's official hikes, but the game, it's almost like the rate of change way he always speaks. It's like that with their policy position. It's never really about the hike. The hike is the absolute. It's the change in their tone or this, that, or the other Fed governor that's on TV that is suggesting that they may or may not hike. Like, that's, I think, the margin where the game is being played now, more so than the hike itself. I think the hike itself is the last thing. It's like the surface area.
Yeah.
But yeah, but I think that's where, it's getting back, and Chris, you raise a good point in terms of, back test, right? Because, this is a good example right here, right? Q4 this year, it's a quad 2 environment, and yet, some of these best performers kind of, month to date, or certainly in the last month, have been stuff that works better in the quad 4 environment, right? Like REITs, healthcare, and consumer staples. They're all up basically around between 4 and like 5.25%. So, that's where the signal and the reviewing the risk ranges on a daily basis, which we all do, but keeping a really keen eye on those factors and noticing, as Gavin pointed out, that the comp Q it put in a lower high today at 15,760, right, versus being north of 16,000, and it doesn't mean, there's a big range there between right now it closed at 15,521, right? So there's still a lot of upside to the top end of the range. But that is really because, Vixen likely, again, we don't get that risk range, but, I can imagine that Vixen risk range is somewhere between, 20 on the low side and like 30, 35 on the top end, right? So it's, the wider the volatility bands are, the greater the width or the breadth of the risk range, and being cognizant of those, and having, shoring up your process so that you are selling into strength, right? It's not the end of the world to be incremental, both on the sell side and the buy side. So going back to kind of Gavin's point about, bonds and having some of those defenders on, and incrementally adding to them here on red can really pay dividends in Q2 or potentially Q3, because you kind of had that foresight. Mike, X2, aka Mike, and I had a quick chat this morning about gold, right? I mean, the gold freaking ripped today again, GLD. And so it's like, patience in these underlying securities, because, we're likely going to have some of these, nuanced days or weeks where it's going to look like a bit more of a quad 1 or a bit more of a quad 4 or what have you. And you're going to get opportunities to add incrementally to those positions that you're going to want on for kind of 2 to maybe 3 quarters going into the back of 2021 or 2022, excuse me. And that's really where I'm focused in the last week, and I think a lot of guys here probably know that, because I've been tweeting about it and whatnot. But if you're not shoring up your book right now with VIX at 18, and let alone if it gets to 16, you're going to be in a world of fucking hurt in Q2 or like back half of Q1. And so you got to be cognizant of where is your exposure, where, what has the best signal strengths, to Gavin's point, right? Like XLRE, it wasn't at the low end of the range, but he still bought it today because that signal strength is really strong, and it works well in both quads. I think, back test around 4% in quad 1 and like 9% in quad 4, right? So again, Joe, I know I just basically poo-pooed, back test, but you still gotta harp on something. But DE and Sam, you guys are both have been kind of listening and asked to speak, and I do unfortunately have to wrap up probably in the next 10 minutes, but we'll be back at this thing tonight at 8:30. But please, the floor is yours, and we'll kind of kick it off or end it with both of your kind of questions or comments.
This is DE is David Edstrom.
Yeah, nice to meet you, David.
The only comment I had, and maybe this is for 8:30, and that is you got to look at the duration of the like BNDD. It's 18, which means 100 basis point drop in rates in the end will be about an 18% appreciation. And you can go through the various TLT is shorter than that. You can find ones that are longer than that, like 24%. So think through, is there a 100 basis point drop? Now, outside of the liquidity event, because the liquidity event rates won't be normal, but that's my primary comment. And I think the thing I grapple with is how long a duration do I go in the bond thing? And what does that mean to
David? I don't want to interrupt you, but I don't understand what you're saying. What do you mean by the duration? And the duration, and the basis point drop.
Yeah, you should find it on your broker dealer page. I'm on Schwab. On all the bond ETFs, if you go down, and it's probably on the other broker dealers, they'll give you a number for duration or effective duration, or you can go to the website of the ETF. The simple rule in duration, let's say if the duration is 18, 100 basis point drop in rates will be an 18% increase in price.
Gotcha. And did you just say BNDD was an 18?
It was 18, yeah.
Gotcha.
And that's not one of the longest ones. You can find longer ones out there. I was just going through it today. This still doesn't tell you what to do, but it's important to think about. Because if rates go back up, we're wrong, then that duration is going to kill you. So I can explain more at 8:30 or any other questions.
No, I was going to say, David, the other day Keith said if we get a real quad 4 in Q2, expect a 10-year to get cut in half. from here, you know, so
Yeah,
that's not
well,
100, but that's what is that, 70 basis points. So,
yeah. So I'm just
um,
using the 100 basis points because the 100 basis points translates to the typically people think in terms of duration as the percentage change in price for a 100 basis point move. And, you know, in the summer of 2020, the 10-year was about 100 basis points lower than where we are now.
Right.
So
It's basically it's basically delta for
so
fixing.
so when Keith went to the IEF, he said, well, I'm going to simplify it. Well, the IEF is maybe a safe place to hold, but it won't work as a hedge if we have the big event. But the IEF, if you're wrong, the IEF, it's really going to be an inflation, rates are going to back up, then the IEF is pretty safe as a place to put your money. That's how I read that.
Versus like a TLT or
Yeah,
an
a
EDV.
TLT, and I can,
Yeah,
I mean,
yeah.
when you start looking for them, I had them down here today someplace, but there's a whole bunch of
EDV, what's EDV? Extended
EDV
duration.
is longer
Extend.
than B and DD.
It's basically 20 years, Gavin, like 20 years or more.
Yeah.
What's the question here?
The question was, we were talking about what's the bond going to do, and when we hit the event or we hit the quad fours, what are the bonds doing for you? And there's potentially, where are the gains? The gains are in long duration bonds.
Yeah, so it sounds like this is, you know, you can choose the duration that you want and
Yes.
size based off of that. If you do long-term bonds, you're obviously going to be a lot more amplified to a move in the long end of the curve.
Yeah, and I'm just
So then
pointing
it's
out.
just a question of how much risk you want to take. You know, assume base case, you're playing for 10-year getting cut in half. Maybe you say that's the same for the 30. Downside cases, maybe we see what happened when the vaccine data came out last November and see where yields went, you know, from there until March or May or so.
Yeah.
And maybe you can kind of call that your downside. So
Yeah, well,
using those as your parameters, size it off that.
Yeah, and the other thing, to manage the position, you look at what's happening on the risk range of the 10-year. And the trend right now, it's neutral. And I've been buying some longer duration because I'm thinking neutral is going to go to bearish. But that's thinking, that's not the number yet. I might be a little bit ahead of myself.
I think that looks like a pretty good base case. I mean, today we had the tightest risk range we've seen in the 10 years since September, and it's tightened now, you know, with a strong signal for a lower high, you know, so it's kind of, it looks like it's capped me, you know, so it's not like, I don't know if we get like a quad one, you know, bonds just seem like they would be a safe place to park, and then knowing that there's a quad four behind it. But then if it accelerates and gets pulled forward, you know, I've already enjoyed having fixed income back in the portfolio. Like, it's just, I like it. I guess I'm old school that way. Like, I want my bonds, I want my equities.
You're an old soul.
You know,
Gavin,
like,
you know.
quad two is like, oh man, like I'm shorting bonds.
Yeah. Well, I'm talking about a piece of the bonds that could have a lot of volatility and are as risky as an equity. But it is something that goes up in quad four in the end. It may get messed up during the liquidity event, right? Because everything does.
You're spot on, Dave, and that's a really good call out. So I appreciate that, and yeah, please, I mean, circle back up. I'll obviously reshare the spaces around 8:30. Sam, you're up, boss.
Sorry, just skip me.
You sure?
I mean, whatever I've done today seems pretty in line with all of you guys. I was going to ask about the XLRE.
Go ahead.
Well, I mean, I think you answered it. The signal was just strong because when I actually noticed that before it was signaled, and I was looking at it yesterday, and I'm just like, it's kind of heading toward the top of the range. I'm not sure if I'm going to buy this, and looks like there's some complacency in the IVOL too. And I was just like, I don't know if I want to buy this, and then saw that it was mentioned earlier, and I'm just like, okay, maybe not. But as far as I know, I
Yeah,
know
so
like
just to
they're both.
clarify, Sam, Gavin bought the XLRE. I did not buy it on Monday either. So I was a buyer on Monday, but I bought stuff at the low end of the range. Again, I probably take on more risk than no, not probably. I 100% take on more risk than Gavin does. and, and so I was a buyer of XLY and triple Qs on Monday, right, Sam? So yeah, I'm waiting. I'm still patiently waiting for the XLRE to try to come in down to kind of the low end of the range. And again, but it's also burned me in the past, right? In terms of like not taking advantage of even just little pullbacks like we got on Monday in the XLRE. So, but anyway, please continue, Sam.
Yeah, I mean, I still got ITB. I built my position pretty low cost, so I'm not too worried about that. I do have a lot of cash sitting, and mostly for the same reasons you guys are. Just been making sales the last couple of days. I sold after that bounce on Monday. I got very, very tense holding my call options that I got on QQQs and SPY. And since I was at near the low of the range, that's when I got it into the close on Monday, and then I sold them yesterday. And as it continued to go up, I still added to my shorts for oil, and unfortunately, I'm not able to short anything. So when it came to shorting oil, I wasn't able to go with the Norway short, but I I added a little bit more to the USO short. But yeah, I mean, a lot of the stuff seems pretty in line with you guys. Got into UUP or added back to UUP that I've been selling into the strength the last couple of days. I got in, I was like, maybe I might go lower, but I mean, a 40 basis point drop in the dollar is pretty big, especially during a time like right now. But overall, I mean, I think Joe was saying it before. It was just this. It just seems like a head fake, and I've been watching the price of Bitcoin too, and you just notice like Bitcoin breaks 49K, but it still never made a higher high. It never made a higher high yet. It was just about to. I had an alert set up in TradingView. What was it, like 49,800 or something?
Yeah,
and it never. I thought it was gonna break it. It was just a couple hundred away, and I thought I was gonna get alerted like in the middle of the night when I wake up, I see it. But no, it ended up pulling back, and it just seems like, well, here we go again, then I'm not sure if I feel too good just going like full on bullish on Bitcoin, even though it keeps on flipping signals and everything, especially Ethereum. But I am trimming both sides, long and short, because I hold them separately. I am trimming it once it reaches their opposite side of the risk range. And just keep doing that, and I'm actually fine watching this thing go make like new all-time highs, and I'm not in it. Like, if that's the case, then so be it. But when that thing when it drops like 10,000 in just a couple of hours. Like, I don't want to be caught in that, my pants down.
Hey, Sam, I think Keith has brought this up, but right now, the way Bitcoin is correlated to the VIX, it's like basically, I don't know, I would think about it as like a levered way to play equities, immediate term, like in the next like 1 to 3 weeks. So yeah, you're right. It's just like the rug could get pulled on you pretty quick.
Oh yeah.
I'm not long Bitcoin. I haven't been for a little bit now.
I think this is the point. It's like all the up until 3 weeks ago, the only thing I was trading was crypto, and now my Coinbase account is at zero. I think everyone that's kind of, saying
I think you should clarify, like zero invested versus like zero you lost.
Oh yeah, I mean, like I closed everything.
You lost everything.
No,
I mean, no. Just to clarify, you traded it well.
And I think, I don't know, you got to give it to the maxis, man, because I mean, all these fucking dweebs like Breedlove and all that. I mean, they've got Jordan Peterson now pumping Bitcoin. It's like, what the fuck? They're good. I will give it to them. They are good.
I thought
They're pumping.
Okay.
No,
I was
I'm
going to
good.
say, I thought recently, I don't know if it was this week or what, but crypto was no longer so, unanimously bullish based on the risk range. And if memory serves, the correlation for risk on environments is, of course, positive. So quad 2 and quad 1,
Yeah.
it's just the same when it's quad 3 or quad 4. I could be wrong on that, but for sure, quad 4, crypto gets hurt. It's a risk asset at the end of the day. And I would just say also, Sam, just from an outsider's perspective here, the way that you're talking about, what's going on in the market, what's going on in crypto seems, subconsciously bullish. We've been really enjoying buying every dip this year, and that's turned out to be incredible. Market regime wise, that was the right thing to do. But even other comments made earlier today talking about how, okay, bonds, will do well when, there's volatility, yields go down, etc. That still kind of sounds like people are thinking, okay, but my equities are going to be fine. Why would I go to bonds if I'm going to make a small amount when I can just stay in my equities? And if we are going towards a deceleration in inflation and GDP and fiscal stimulus, around the world, it's no longer a given that we're going to see asset prices going up. So I would just offer that comment as everyone's kind of evaluating what's going to happen next year.
Yeah,
For
and
sure.
Tibbsy,
Thank
I
you.
hope you can join at 8:30 if you're free. That's Eastern time. It's a great way to sum up. And just for when I said I'm a seller, I haven't been selling small. I have cash back up to anywhere from 15 to 25% in the accounts across both basically two retirement accounts and a taxable, basically, long short account. So yeah, that's where I'm at. I've been aggressively selling. I was a buyer on Monday and I'm a seller today, and I am 100% righting the wrongs in my book in terms of getting the small caps out of there, taking the losses where I need to. It's also offsets gains that I've had this year. Obviously, right? We were long energy and financials; those are awesome out of those bad boys. But yeah, man, it's a great point. It's a really good one to end on for right here. I apologize for cutting it short because this is amazing conversations, and thank you for everybody who joined. I will be back at we will or whoever can join, please circle back around 8:30 p.m. Eastern. We'd love to hear other conversations. Chris, I know it's and anybody in overseas or what have you. I know it's late there, so appreciate you staying up and chatting with us. It's always a pleasure.
Thank you so much, Robert. Everyone give this guy a follow. Let's get you up to 1K followers, right?
Oh,
Yeah,
yeah,
I was
please,
gonna
at
say,
least.
everybody follow you.
I appreciate that. I appreciate that, guys. Yeah, I need 1,000. I guess we need 1,000 in order to record these sessions, so it is helpful for everybody. But yeah, no, I'm not. We'll figure it out. But we'll yeah, but I appreciate that. Sorry, now you got me blushing over here, Jimmy and Sam. I appreciate it. All right, team. We'll chat later. Thanks.
Thank you.
Thanks, Robert.